In the autumn of 2008, the world stopped turning. Banks failed. Markets vaporized. The intricate machinery of the global economy seized up, threatening to drag us all into a second Great Depression. Millions lost their homes. Tens of millions lost their jobs. An entire generation lost its faith in the future. It was a collapse, a catastrophe, a moment of shared global panic. But what if that is not the whole story? What if, hidden inside the greatest financial disaster of our lifetime, was the greatest financial opportunity in history? What if the collapse wasn't an ending for everyone? For a select few, it was a beginning, a fire sale on the American dream. The moment the rich didn't just get richer, they got everything. We were told a story of reckless bankers and unavoidable consequences. A story of a system on the brink, saved by a necessary, if painful, rescue. We were told the bailout was for us, to protect our jobs, our savings, our way of life. But in the years that followed, something strange happened. As Main Street struggled through a brutal decade of austerity and slow recovery, Wall Street soared to unimaginable new heights. Wealth inequality, already a chasm, widened into a canyon. The very architects of the crisis walked away with fortunes intact, while those who paid the price were left with the rubble. How did this happen? How did a crisis caused by the wealthy become the single greatest engine for their enrichment? Was the system truly saved? Or was it simply reconfigured to save the powerful at everyone else's expense? The official story is one of failure and rescue. But the truth is a story of design, a story of a collapse that was not a bug in the system, but a feature. To understand the crash, you have to first understand the dream it was built on. The American dream. It was not a dream of mansions or private jets. For most, it was simpler, more tangible. It was the dream of a home, a piece of land, a place to raise a family, build equity, and pass something on to the next generation. For decades, home ownership was the bedrock of middle-class wealth. It was the ladder up. And in the late 1990s, the government, with the best of intentions, wanted to extend that ladder to more people than ever before. But at the very same time, a different dream was taking shape on Wall Street. A dream of deregulation. The walls that had been erected after the Great Depression to keep traditional banking separate from risky investment banking were seen as ancient relics, holding back progress and profit. In 1999, those walls came tumbling down with the repeal of the Glass-Steagall Act. The financial world was unleashed. Megabanks were born, entities so large, so interconnected, that they would soon become too big to fail. With their new powers, these financial titans invented a new kind of magic. They called it financial innovation. They created weapons of mass financial destruction, but sold them as instruments of prosperity. The most potent of these was the mortgage-backed security, or MBS. The concept was deceptively simple. A bank would take thousands of individual home loans, mortgages, and bundle them together into a single package. This package, this bond, could then be sliced up and sold to investors around the world. It was presented as a way to spread risk. If a few homeowners in Ohio defaulted, it would not matter, because thousands of others in California and Florida were still paying. It was a way to turn the humble mortgage into a global commodity. But the machine needed to be fed. To create more of these securities, they needed more mortgages. And when they ran out of creditworthy borrowers, they started lowering their standards. This gave birth to the subprime loan. These were loans given to people with poor credit, unstable incomes, and little to no down payment. They were sold with low teaser interest rates that would later explode, trapping the borrower in a cycle of debt. Financial institutions sent armies of mortgage brokers into vulnerable communities, armed with deceptive products and the promise of the American dream. They called them ninja loans. No income, no job, or assets. They were selling dreams they knew were nightmares in disguise. But why would they take on such risk? Because they had no risk. The moment a bank issued a subprime loan, it sold it off to Wall Street, which bundled it into an MBS, collected a fee, and passed the risk on to the next person in line. It was a game of hot potato with a time bomb at its core. To make these toxic bundles look safe, the banks turned to another set of gatekeepers, the credit rating agencies. Companies like Moody's and Standard & Poor's were paid millions by the very banks whose products they were supposed to be rating. Unsurprisingly, they stamped these packages of ticking time bombs with their highest seal of approval, A. The same rating given to the safest government bonds. The watchdogs were not just asleep. They were paid by the wolves to look the other way. This created a global frenzy. Pension funds, city governments, foreign investors, everyone wanted a piece of the supposedly safe, high-yield American housing market. The entire global financial system became addicted to this flood of toxic debt, all built on a foundation of lies and the false promise of ever-rising home prices. It was a skyscraper built of sand, and the architects were getting rich on every fraudulent brick they laid. By 2006, the first tremors could be felt. The thing that was never supposed to happen, happened. Home prices, which had been climbing for years in a speculative bubble, began to stall. Then, they began to fall. Suddenly, the complex mathematical models that Wall Street had used to justify the safety of their products were revealed to be worthless. They were built on one fatal assumption, that home prices would never go down nationwide, all at once. As prices fell, homeowners with subprime loans found themselves underwater, owing more on their mortgage than their house was worth. The teaser rates on their loans began to reset to impossibly high levels. Foreclosures began to spike. The fuel for the Wall Street machine was running out, and the securities built from it were starting to sour. The first major domino to wobble was a Wall Street investment bank called Bear Stearns. In March of 2008, it became clear that the firm was holding billions in toxic mortgage assets that were virtually worthless. Panic ensued. No one wanted to lend to them, fearing they would not get their money back. In a matter of days, the 85-year-old firm was on the verge of collapse. This was the system's first heart attack. The Federal Reserve and the Treasury Department, led by former Goldman Sachs CEO Hank Paulson, engineered a rescue. They brokered a sale of Bear Stearns to its rival, J.P. Morgan Chase, and crucially, the Fed put up $30 billion of taxpayer money to backstop Bear's worst assets. A message was sent to the market: we will not let a major institution fail. A false calm settled over the summer of 2008. Officials appeared on television, reassuring the public. The chairman of the Federal Reserve, Ben Bernanke, insisted the problems were contained to the subprime market. The president declared that the fundamentals of the economy were strong. It was a collective act of denial. Behind the scenes, the contagion was spreading like a virus through the veins of the financial system. No one knew who was holding the worthless assets. Trust, the lubricant of the entire banking world, evaporated. Banks stopped lending to each other. The credit markets, the lifeblood of the economy, were beginning to freeze. Then came September. Another investment bank, Lehman Brothers, was in even worse shape than Bear Stearns. It was drowning in toxic real estate assets. Everyone expected another bailout, but this time, the government made a different choice. There was immense political pressure. The public was outraged at the idea of bailing out another reckless Wall Street firm. The government, in a catastrophic miscalculation, decided to make an example of Lehman. They believed the system could withstand its failure. On September 15, 2008, Lehman Brothers declared bankruptcy. It was the largest bankruptcy in American history. They thought they were teaching the market a lesson about moral hazard. Instead, they had pulled the pin from a grenade and thrown it into a munitions factory. The failure of Lehman was the moment the hidden crisis became a public catastrophe. It triggered a complete and total collapse of confidence. The world discovered that a massive insurance company, AIG, had sold trillions of dollars in credit default swaps, essentially insurance policies, on the toxic mortgage bonds. With Lehman's failure, AIG was on the hook for billions it did not have. AIG was connected to every major bank in the world. Its failure would not be like Lehman's. It would be an extinction-level event, bringing down the entire global financial system. The heart attack had turned into full-blown cardiac arrest. Panic was no longer confined to the trading floors of Wall Street. It spilled onto Main Street. People rushed to pull money from their bank accounts. The machinery of the world was grinding to a halt. The abyss opened up before us. In the chaotic days following Lehman's collapse, Treasury Secretary Hank Paulson and Fed Chairman Ben Bernanke went to Congress with a message of pure terror. They warned of a complete economic meltdown. Martial law, a world without functioning ATMs or credit. They presented a 3-page document, a proposal for a $700 billion bailout fund called the Troubled Asset Relief Program, or TARP. They demanded a blank check with little oversight to buy toxic assets from the failing banks. The story sold to a terrified public and a panicked Congress was simple. We must save the banks to save the economy. It was financial blackmail. Give us the money or the world ends. After a failed first vote that sent the stock market into a historic plunge, Congress relented. They passed the bailout. The money began to flow. The public was told this was the price of stability. But TARP was only the story they told us in the light of day. The real rescue, the one that would fundamentally reshape our world, was happening in the shadows, with a tool few had ever heard of. It was called quantitative easing. QE. It sounds complex, but the idea is brutally simple. The Federal Reserve, America's central bank, created money out of thin air. With a few keystrokes on a computer, they electronically printed trillions of dollars. They did not use this new money to help homeowners facing foreclosure. They did not use it to fund infrastructure projects or create jobs. They used it to buy the toxic mortgage-backed securities and other worthless assets directly from the banks. It was the largest financial cleansing in history. The banks got to swap their garbage assets for pure, newly created cash. Their balance sheets were miraculously healed. But this was more than just a rescue. It was a pivot. The government did not just save the old system. It created a new one. A system where the central bank's primary role became propping up asset prices. As the Fed pumped trillions into the financial markets, that money had to go somewhere. It flowed directly into the stock market. It flowed into corporate bonds. It flowed into high-end real estate in major cities. It flowed into fine art and luxury goods. It flowed into every asset class owned primarily by the wealthy. This is the great revelation of the crisis. The government's response created two entirely different recoveries. For Main Street, there was the Great Recession. Mass unemployment, wage stagnation, a lost decade of economic pain. For Wall Street and the asset-owning class, there was the greatest bull market in history, artificially inflated by the Federal Reserve's endless supply of new money. The government did not fix the economy. It bifurcated it. It created a permanent backstop for the rich while offering austerity and hardship to everyone else. And what about accountability? Of the thousands of executives who drove the global economy off a cliff through fraud and recklessness, virtually none went to jail. The banks, deemed too big to fail, became even bigger after the crisis, gobbling up their weaker rivals. They paid back the TARP money, often with interest, a fact they trumpet as proof the bailout worked. But they never mention the trillions in nearly interest-free loans and the QE asset purchases that truly saved them. They paid fines, which they treated as a simple cost of doing business, while their leaders collected massive bonuses, sometimes mere months after receiving taxpayer funds. The system did not just protect itself, it rewarded itself for nearly destroying the world. The collapse was not a failure of the system. The response revealed the system's true purpose: to protect capital, to protect the powerful, and to ensure that no matter what happens to the real economy, the wealth of those at the very top remains insulated and continues to grow. The collapse was the mechanism that made it all possible. The response to 2008 was not a one-time emergency measure. It was the creation of a template, a playbook for all future crises, and we did not have to wait long to see it used again. When the COVID-19 pandemic hit in 2020, the world economy once again shuddered to a halt. But this time, there was no hesitation. The Federal Reserve and other central banks around the world immediately opened the floodgates, deploying the 2008 playbook on an even more massive scale. They slashed interest rates to zero. They launched an unprecedented program of quantitative easing, printing trillions more dollars in a matter of months than they had in the years following the financial crisis. Once again, the stated goal was to stabilize the economy and ensure markets continued to function. But the effect was the same. This tsunami of new money flowed directly into financial assets. The stock market, after a brief, sharp dip, rocketed to all-time highs, completely disconnected from the reality of a world in lockdown, with tens of millions unemployed. We saw the birth of the K-shaped recovery. For the professional class who could work from home and owned stocks, their net worth exploded. For essential workers, small business owners, and those in the service industry, it was a period of immense hardship and uncertainty. The wealth gap became a gaping wound. The housing market, supercharged by rock-bottom mortgage rates and a flood of institutional cash, became even more unaffordable for a new generation. Cryptocurrencies and speculative tech stocks became casinos, fueled by cheap money looking for a return. The lesson of 2008 was not that we should prevent such reckless behavior. The lesson the market learned was that the Federal Reserve will always be there to bail out the owners of assets. This creates a dangerous phenomenon known as moral hazard. The biggest players on Wall Street are no longer taking real risks. They are playing a game where the upside is all theirs, and the downside is absorbed by the public through central bank intervention. They can make increasingly risky bets, knowing that if they win, they keep the profits. And if they lose, a safety net woven by the money printer will appear beneath them. The crisis playbook has become a permanent feature of our economy. Every time the market coughs, every time a new challenge arises, the solution is always the same: print more money and funnel it into the financial system. This is not a solution. It is a tranquilizer. It masks the underlying problems of a fragile and unequal economy, while concentrating wealth and power at the very top. We are now living in a world built by the response to 2008. A world where the stock market is not a reflection of economic health, but a reflection of central bank policy. A world where saving and hard work are punished by inflation, while speculation and asset ownership are rewarded. The collapse did not end. It just went into remission, leaving behind a system more fragile, more unequal, and more dependent on its next fix than ever before. What was truly lost in 2008? It was not just homes, jobs, and trillions of dollars in wealth. It was something far more precious and far harder to rebuild. We lost trust. Trust in our financial institutions, trust in our regulators to regulate, trust in our government to act in the interest of all its citizens, not just a powerful few. We lost trust in the very idea of a shared prosperity, in the promise that if you work hard and play by the rules, you can build a better life. That promise was broken. It was replaced by the harsh reality of a tiered system, one for the owners and another for the workers. One for those who can borrow for pennies and watch their assets inflate, and another for those who live paycheck to paycheck, burdened by debt. The response to the crisis did not just create economic inequality. It created a kind of new financial feudalism, a world where your destiny is determined less by your effort or innovation and more by whether you already own capital. Owning assets has become the only reliable path to security, creating a desperate scramble that pushes prices ever higher, further out of reach for those who are not already on the inside. The story of 2008 is not a story of the past. We are living in the house that it built. The political polarization, the social unrest, the deep-seated cynicism that defines our era, so much of it can be traced back to that moment, to the profound sense of injustice that a generation felt when they saw the system bail out its architects and abandon its victims. The system did not break in 2008. It was revealed. It worked exactly as it was designed to, protecting its own at all costs. The decisions made in those frantic weeks of panic and fear were not temporary fixes. They were foundational choices that have locked us into a dangerous cycle of boom, bust, and bailout, a cycle that relentlessly transfers wealth upwards. The final question is not when the next collapse will come, because in a system this fragile and addicted to stimulus, another is inevitable. The final question is, when it arrives, who will we choose to save? Will we run the same playbook, rescuing the assets of the few at the expense of the many? Or will we finally find the courage to build something new? Something more resilient, more equitable, and more worthy of our trust. The last collapse made the rich richer. The next one is up to us.